Hey gang, welcome to Time in the Market, the third best investing show based in my basement, so it's pretty high praise if I say so myself. A lot of good shows there. Talking about what's going on in the market today. It's been a while since I made a video, but I figured I'd start making them with a more regular cadence, and I know I've said that before, but this time it's not a lie, it's probably a lie. What is going on in the market? Well, the market is down today despite the fact that the government stepped up to bail out a Silicon Valley Bank, which essentially collapsed in a matter of 48 hours. I'll go over why that happened and why it could happen again, actually. Another bank, Signature Bank, closed. So, what the government is essentially saying is that we're not going to bail out the investors in those banks. If you have equity in those banks, you're boned. Sorry, guys, but we do want to make sure that the depositors get their money back. And that is a good thing because, for example, Silicon Valley Bank had over 200 billion plus in deposits. A lot of those were small to medium-sized businesses, including businesses like Roku that might have trouble making payroll if they couldn't access their funds. So they're going to be able to access their funds now going forward. And they're also saying that to prevent more things like this from happening, they're going to introduce a new program where banks can take their mortgage-backed securities or their treasuries and essentially get back par value on those, because par value is what's important. If you held these securities to maturity, you would get your money back as a bank. But since that's not the case, and maybe banks have to sell now because people are wanting their money back, that is a problem because those securities are now worth a lot less than par value. So what happened, first of all, with Signature and what happened with Silicon Valley Bank? Well, think about it this way. Let's open up an Excel spreadsheet here. And let's say in 2021, your bank had $10 billion in deposits. What they have to do with those deposits as a bank is they invest them in something. And generally, they invest them in something that's relatively safe in normal times, such as treasury securities or treasury bonds, whatever. So let's say they own bonds. They take those $10 billion in deposits and they buy, let's say $8 billion worth of bonds in them and keep $2 billion in cash. So that's great and all. Fantastic. Bonds are paying a low yield at that point in time, but they have to do something with that money. So maybe they stretch for yield and buy 10-year bonds or something like that and get a 2% yield, which essentially gives them some income for the deposits that they get, so they can make some money as a bank. So 2022 happens, a lot of money gets pushed into the marketplace. A lot of that money has to go somewhere. So a bank like Silicon Valley Bank suddenly sees this huge influx of deposits, and it goes from 10 billion to 90 billion. These are not real numbers for Silicon Valley Bank, but they do the same thing. They keep some of it in cash. Let's say they keep 4 billion in cash and they put 86 billion of that in bonds. So that's fantastic. Safe bonds, can't go wrong with treasury bonds. The problem is that as you look at yield over here, maybe they're buying at 2% here, maybe they buy at 1.8% here as yields drop close to zero. So now 2023 happens. The banks are seeing a problem arise in that they bought all of these bonds often at extended periods. So let's say they bought bonds that have a 10-year maturity. So they offer a 1.8% yield, but you'll get all of your money back in 10 years. That's kind of what a treasury bond is. That's why it's seen as safe. But 2023 happens, something that hasn't happened in a while starts to occur. The government starts bumping up rates. And by the government, I mean the Fed. The Fed starts bumping up rates. So those yields that were at 1.8% that the banks are now locked in at become a problem, because your deposits maybe start being the same, your bonds are the same, but the fair value of those bonds, what you can get on the marketplace if you were to sell them today, remember, you can get all of your money back if you hold them for 10 years or however long the maturity period is of that bond. But now the fair value of those bonds drops quite a bit. So even though you have $86 billion in bonds on the books, if you were to sell them on the secondary marketplace, you could only get 76 billion back, because now your yield is still 1.8% for those bonds, but market yields are 4%, for example, or higher. So you can go out to the primary marketplace today and get a 4% bond, but these banks are locked in at 1.8%. So that's normally not a problem because you don't see a lot of people needing money. But what also compounds this problem in the case of Silicon Valley Bank is that they bank with a lot of startups. They bank with a lot of tech companies. And those tech companies are starting to struggle a bit. They need more money. So they start going to Silicon Valley Bank and saying, well, we need some of those deposits back to meet payroll, to make investments, to keep our business going, to not go out of business, essentially. So as you start seeing this, what Silicon Valley Bank has to do is, hey, our deposits have dropped to 80 billion because some larger companies wanted some of their money back. We have to sell, we might have a bit of cash to cover those that money that's being called away from us, but now we need to start selling some of these bonds. So even though we have these bonds that are worth $86 billion on the books, we have to start selling them on the secondary marketplace, which means that we are suddenly short some money because these bonds are not worth what they were worth when we bought them. So if only a couple of companies need their money, that's not really a problem. But suddenly somebody hears about this. Somebody says, hey, there's a little bit of a problem here because Silicon Valley Bank is not as well capitalized as they thought they were. Because if you really only own $76 billion worth of bonds, you're short $10 billion, right? So $10 billion gets called back. It's like, well, maybe we're still okay at that point. But if somebody starts a rumor that says, well, they might be in trouble, and that rumor starts going around Silicon Valley, and more companies start saying, hey, Silicon Valley, we need our money back. That's what's called a bank run. And now Silicon Valley is in trouble because they are forced to start selling these bonds below what they're carrying them at. And essentially, they don't have enough money to cover all of their deposits, right? And maybe this is, they have a $10 billion shortfall, or maybe it's more, but that becomes a problem. If you're $10 billion short, somebody's going to lose out on their money. And if you hear about that, you're probably going to want to go to the bank and get your money out because you don't want to be the last person on the sinking boat. And that's essentially what happened with Silicon Valley Bank. They were short on their deposits. People started pulling out money. They didn't have enough to cover it. They had to make a fire sale where they sold about $20 billion in bonds, losing about $2 billion on those alone. If they sold more, they would have lost more. Suddenly, they said, hey, we're going to have a shortfall here. We're going to need to raise money via an equity raise. They were not able to do that. That sort of fell through. The stock started crashing. More and more people started asking for their money that they didn't have right away because sometimes it takes a bit of time to sell all those securities. And if they sold all of the securities, it would have been at a loss anyway. So the FDIC had to step in and take over the bank because a problem was arising and they didn't want it to spread further. And then after that happened, 48 hours of trouble was afoot in that people were seeing that, hey, maybe this is going to be a problem with other banks. And it totally is. And that's why the Fed had to step in and basically say, hey, we're going to backstop Silicon Valley. Don't worry about it. We're going to cover all of your deposits. So don't go to your bank and pull out all your money because they don't want this to happen in other banks. Because is this a problem in other banks? It totally is. This is going to be a problem in every bank in America at this point because this happens everywhere. Banks get deposits. They have to do something with that money in order to earn income. And the safest place to put that money is treasury bonds from the government that are guaranteed. And they are guaranteed in the sense that you'll get all of your money back if you hold it to maturity. But some of these banks bought long-term bonds, 10, 15-year bonds in order to chase yield because they don't want to get 0.2% on a one-year bond. They wanted to get 2% on a 10-year bond. But now that interest rate has risen, generally what happens is for every year in duration, you lose 1% for every 1% move in yield. So if yields have risen 3% and you have a 10-year bond, you potentially lost 30% in value. And if you have to sell that on the secondary market, 30% of $9 million is $27 million. You potentially are $27 million short, $90 billion that I had in this example. You're potentially $27 billion short in your deposit base. So if people start taking their money out, you have a hole there that somebody has to fill, and that could create a bank run, that could create banks going under, and that could happen across the board. And how do you know if your bank has that issue? Well, hopefully this won't be a huge problem right now because the government has stepped in and said that, hey, listen, if you are having trouble with the valuation of your bonds, if you bought bonds that were, a higher term than you should have as a bank, because your job as a bank really is risk management, and these guys didn't do a good job of managing their risk, knowing that rates might go up in the future. You probably want to stay at a low duration bond. They had 10-year plus bonds on their books yielding 2%. Now that yields are 4% plus, that's a problem. So how do you know if your bank has that issue? Well, all of them do, honestly. I will just open up, for example, Schwab's. Let me open up Schwab's 10K here. You can kind of look at their financial statements and you can say, well, what do they have as far as their assets go? And Schwab is part brokerage, part bank account, so part bank rather. So it's kind of harder to read some of these statements, but you can kind of see Schwab. Hey, the carrying value of the U.S. mortgage-backed securities that we have is 173 billion. Well, the balance at fair value right now is 158 billion. So we have a almost $15 billion hole in our balance sheet because of the valuation change in these mortgage-backed securities that we have. There's also some holes on some of the mortgages that they had. As rates go up, the valuation of those buildings that are backing those mortgages goes down as well. The crazy thing is I have a mortgage, for example, of 2.75%. So a bank allowed me to borrow money from them for 30 years at 2.75%. And now I can go into the bank and I can get a CD that pays me 5%. So they're paying me more money to take those deposits in than they're getting in the offers that they're giving to certain people that locked in mortgages in 2020, 2019, 2021, or whatever before interest rates go up. And the same thing happens with the mortgage-backed securities or treasury bonds that they bought. If they locked in these bonds at 2%, 3%, whatever, now they have to pay people 4% to get money in. That's a miscalculation on their part, right? They're paying more to get deposits in than they're getting for a lot of those deposits in the first place. And that's why the valuation of these mortgage-backed securities or treasury bonds on their books goes down. So now if their deposits are, in this case, $18 billion short because of the difference in first mortgages and or mortgage-backed securities and their fair value versus their carrying value, if people start calling money back, they say, I want my deposits back, they don't have enough money to cover all of it. And now this is only a problem if everybody wants their money back, right? Which is kind of what happened with Signature Valley Bank. Once people heard that this thing was close to collapsing, it happened really quickly because everybody wanted their money back. And they were short because the fair value on their balance sheet was much lower than the carrying value of those securities that they bought in 2020 or 2021. So Schwab, could it be in trouble? Maybe, right? If people start wanting their money back en masse, it's going to be a problem across the board in every bank because these banks got a lot more money in 2020 and 2021 as the government printed money, and they had to do something with it. So they bought bonds at low rates. Hopefully they didn't buy them at very long durations because if they did, they're in trouble. Their valuation is going to go down of those bonds and they're going to have a big hole in their balance sheet. So Schwab, for example, has a maybe $18 billion hole in the balance sheet. That's pretty big considering this is a company that's got maybe $30 to $40 billion in common equity. Could be a problem if it becomes bigger. If rates keep rising, this fair value is going to keep going down. Now, eventually it'll catch up, but it's still going to be a problem for the next couple of years because the fair value is going to be lower than the carrying amount of these backed securities, U.S. backed securities. So they're safe in the sense that if you hold them to maturity, the valuation is going to be realized. By the time the 5 years or the 10-year length of the bond passes, they're going to get back the full 173 billion. But if they had to sell them on the marketplace today, they'd be $15 billion short. And this is not just a Schwab problem, but you can kind of see why Schwab is down 20 to 30 or 40% or whatever it is in the last couple of days. Even now that the government has stepped in and said that, hey, listen, if you run into an issue we are essentially going to cover you at your carrying amount. We're going to give you the funds that you need at par value and give you a year to pay us some fee for it. And the fee is relatively small, so it's relatively small. So it does give banks a pretty big lifeline at this point. So as long as more bank runs don't happen, this should not be a problem. However, the FDIC budget is only 100 billion or so at this point. So they certainly need some money to cover this if it becomes a bigger issue. If it's only Signature Valley Bank or Silicon Valley Bank or Signature Bank, can they cover that? Yes, because those are, maybe 80 cents on the dollar. So if it's 100, 200 billion dollars in deposits that they have to cover, they're still going to be able to sell the majority of those mortgage-backed securities and treasury bonds at 80 cents to the dollar because that's what their fair market value is, and they really only have to cover the excess, maybe 40 billion or something like that. But if another bank goes, if another bank goes, if another bank goes, then it could become a problem. And this is 250 billion or whatever Silicon Valley Bank was. It's a lot, but it's still a small bank when you consider the other major banks that are out there. Even Schwab has bank deposits more than Silicon Valley Bank. Then you can look at something like Wells Fargo, and you say, well, Wells Fargo is like a massive bank. They probably don't have an issue. Well, they still do, because you've got these held to maturity bonds, you've got these available for sale bonds, and they basically, if you look at their balance sheet from, this is Q3 of 2022, so it might be worse right now because I couldn't find one for Q4 of 2024 for whatever reason. They have a $50 billion hole in their balance sheet, right? Because if they were to sell all of these bonds at the fair market value today, they only realized $371 billion against a net cost of $425 billion when they bought these bonds. Now, that's a lot bigger than Schwab, but this company is also a lot bigger than Schwab, right? So it makes sense that they just have more bonds, that the hole in their balance sheet is bigger. Their assets are almost $2 trillion. So when you talk about 50 billion against 2 trillion, is that a lot? No, but when you consider it against their common equity, which is somewhere in the $120 billion range, it's a big percentage of that, right? So if they suddenly were down X amount of money because people started calling their money back, it would wipe out a good portion of their common equity, if not all of it, and make this stock a lot less valuable, which is why you're seeing the market react the way it's reacting. It was down quite a bit in the face of this happening. Probably if the government didn't step in and say, listen, we're going to put this program in place that's going to allow these banks to get par value out of their bonds, because a lot of them are probably down as much as $50 billion on the valuation of those bonds due to the fact that they locked in 2% rates and now the rates are at 4 to 5%. That would be trouble. The market would probably be down a ton, so it's good that they did something. But this is still not an easy solution to a problem that's going to be around for a while, right? These banks are going to have holes in their balance sheets for a while because I don't see rates falling anytime soon. And as long as rates keep going up, if they do keep going up, these holes are going to become bigger. Because like I said before, if you are locked in at 2% for 10 years, and now rates are 5 to 6% and continuing to rise, the fair value of those bonds is going to keep getting worse and worse and worse. And yeah, you can sell them on the open market, but that means you're locking in a loss that is not going to be easily recoverable and going to put your deposit base at risk. Because now, your $90 billion in deposits are only covered by $75 billion in bonds, or whatever it may be, because of the valuation change. And this, like I said, is not a problem that's only there with First Republic Bank, which is down 60% today. It's not only there with Signature Bank, which is closed, that the FDIC took over. It's not only there with Silicon Valley Bank that the FDIC took over. It's there with probably every bank that has bought bonds in the last couple of years, because those bonds were bought at lower rates and the values of those bonds has dropped. So that is what's going on. That is why the market will probably be a bit murky until we figure out exactly what's happening. So keep that in mind as you're investing. Remember, guys, this information is just for entertainment purposes only. I am not a qualified financial advisor. Please talk to your financial advisor before making any investment decisions. At the end of the day, I'm still a believer in the marketplace. I mean, every time something like this happens, somebody steps up and figures it out, fixes it, which is what the government did here. Doesn't mean we're out of the woodwork. Doesn't mean that everything's gravy. There's still going to be problems. People are going to be more reticent to trust their bank. People are going to think about, do I want to be in a small bank? Do I want to keep a ton of money in a small bank, knowing that they're so much more likely to have an issue if something like this arises? Does it make sense to move money into multiple banks so that you have FDIC coverage on more of your money, right? The FDIC coverage technically tops out at $250,000 per account per person at a bank. So if you have more than that at a bank, does it make sense to move it elsewhere? Potentially. Is more money going to flow into the big banks, the systematically important banks? The government cannot let Wells Fargo go under because the amount of money that they hold is immense. JP Morgan and Chase is another one, Citigroup, Bank of America, banks that were in trouble in 2008, basically were bailed out in 2008. Will the government bail out more banks going forward? They've kind of set this precedent now that, hey, we're going to cover all deposits on Silicon Valley Bank. Well, what happens when some other bank goes under? They have to maybe continue that, right? Is there going to be enough money in that fund? There are going to be changes that will need to be made in order for this to exist. I think if you're an investor in bank stocks in general, you're going to see this be a negative thing for those. They're probably going to have to pay into some sort of fund, pay more in fees for this government protection, because they are, yet again, leading a market fallout because of the decisions that they made. And these weren't necessarily terrible decisions like they were in 2008. They were just decisions that didn't consider the fact that interest rates may rise pretty quickly, pretty soon. And when you're locking in things for 10 years plus at 2%, and interest rates suddenly rise to 5% in a matter of weeks, this is what's going to happen. Your balance sheet is going to look ugly. Your balance sheet is going to be impacted. So it's a yikes at this point. Obviously, who knows what's going to happen. I think what the government did was the right thing to do, but there could still be more fallout from this because every bank is impacted. The one thing that was unique about Silicon Valley is that it was a lot of big depositors and not a lot of small depositors. Only like 3% or something like that of that money was FDIC insured. So most of it was 250,000 plus. So it was a lot of businesses, a lot of startups, etc. They had funds in there. So it wasn't just individuals, whereas other banks are more individual based. Are there other banks out there that have exposure to large businesses? Yes. And those banks are probably in more trouble than those that are focused on the commercial side, the small, very small businesses, the individual, etc. Because businesses are more likely to pull out their money knowing that they're not insured, whereas most individuals probably don't even know this is happening, honestly. Like most of the people in my family didn't even hear about this. Although if you were on Twitter, it was like the world was ending. I mean, God, I hate Twitter so much. It's like the end of the world for every little thing. If you're an investor, get the hell off Twitter because it's not good for your mind. But at the end of the day, this is certainly an issue. It's certainly an issue that could become bigger and more widespread. And it's certainly an issue that is going to impact, and already impacts, pretty much every bank in the United States. So keep that in mind as you're investing, as you're banking, etc. But just wanted to get on, kind of talk about it, get my thoughts out there. As always, thanks for watching. Let me know what you guys think. Let me know if you guys want to see any other videos about anything. I'll try to make more videos, maybe about general market stuff. But I've really been busy and had some family issues in the past couple of months, so I've been away. But thank you for watching, and have a good rest of your day.